Lecture 12, Trading Securities.
Chances are, if someone mentions trading stocks to you, or trading any kind of financial product for that matter, you get the mental image of people running around the floor of some crowded exchange, gesturing wildly and yelling, "Buy!" or "Sell" at the top of their lungs. We've come to think of trading as a chaotic activity that's only conducted at top speed by people out to make a fast buck. Trading, after all, is just pure speculation that doesn't have anything to do with the actual value of stocks or other securities, right? Now we're going to discuss trading from the ground up, so that you can see how securities trading really works and what it actually does for the financial markets. My goal is to help you build up some trust in our system of securities trading, based on a solid understanding of how and why people trade securities. My hope is that if you trust the trading system, you'll want to participate in it. If you can't imagine trading securities yourself, it might be because your definition of trading isn't broad enough. Most people think that securities trading has to take place quickly, so that you sell a security within minutes or even seconds of buying it. While it's true that many traders do trade literally as fast as lightning, there are plenty of other traders out there who buy today and don't intend to sell for years. But even if years pass between buying and selling a security, that's still trading. If you ask the average person whether they trade securities, they'll probably say no. But ask the same person whether they invest, and they'll probably say yes. Is investing the same as trading? Well, for many securities, the answer is yes. If I invest in stocks today, I know that I'll have to sell the stock someday when I reach my investing goals. So I buy now with the intention of selling later. If that isn't trading, then what is? What most of us call investing is really a form of securities trading. And since all of us should invest so we can reach our financial goals, everyone needs to understand the basics of securities trading. I want to introduce the basics of securities trading by pointing out some big similarities and differences between securities trading and the ways that we're accustomed to buying and selling other goods and services. The first difference is that in our usual economic lives, we have a preference for buying new things, not used things. For products like clothes and groceries, that's completely understandable. For many people, this preference for buying new extends to goods like cars and homes as well. This differs from securities trading because, for the most part, the securities trading market is a market for used securities. In this case, the word pre-owned is more accurate. Economists draw a distinction between the markets for new products and used products, calling the market for new products the primary market and the market for used products the secondary market. In finance, the primary market is where securities are issued. We learned about that process in a previous lecture. In the primary market, a borrower issues, or really sells, a brand new security to some lender. In the secondary market, on the other hand, everything for sale has had at least one previous owner. For example, someone selling a security on the secondary market may have purchased the security from the issuer, which means that they're the first owner. But in many cases, the person selling a security on the secondary market is the 5th or 10th or 100th owner of the security. It's possible for securities to be sold and resold hundreds or even thousands of times on the secondary market. And with some long-lived securities like stocks, that actually happens. So why don't people have a preference for buying new securities? Well, securities don't really wear out, so there isn't the same stigma attached to used securities that there can be with other used goods or used assets. Pre-owned securities are nearly perfect substitutes for brand new securities, as long as all the other characteristics of the securities are the same, of course. There are also a lot more used securities out there at any given time than there are new ones being issued, so the selection of securities on the secondary market is much better. Finally, it's usually cheaper and easier to buy securities on the secondary market because these markets are larger and better organized than primary markets for most securities. When you put all those factors together, you can see why we tend to buy used securities instead of new ones. I just mentioned that used securities are nearly perfect substitutes for brand new ones. There is an important difference between the primary and secondary markets in terms of what happens to the money that the buyer of the securities pays to the seller. An example will make this clear. Suppose Apple decides to issue 1 million shares of new stock. This happens on the primary market because these are brand new shares. A person who buys 100 of these new shares says, I just invested in Apple, and indeed the money they pay for these shares goes to Apple Incorporated. On the other hand, suppose someone buys 100 shares of Apple stock on the secondary market. The buyer says, I just invested in Apple, which makes it sound like the buyer of the stock on the secondary market is also paying money to Apple. The reality is that the money goes to the person who sold the shares on the secondary market. And that makes sense. After all, if you buy a used Ford, the money you pay goes to the previous owner of the car, not to Ford Motor Company. Yet the buyer of the shares on the secondary market does have a point when they say that they're investing in Apple. The shares of stock represent a loan to Apple Incorporated, as we learned in the previous lecture. The buyer of the shares on the secondary market takes over the loan from the previous owner of the shares. So the buyer of the shares is investing in Apple, but not by paying money directly to Apple. The second difference between trading securities and buying other goods and services has to do with what you get for your money. Whenever you buy a good or service, you receive something concrete like a shirt or a car wash. But when you trade securities, you don't get anything physical for your money. The closest thing you'll receive is a piece of paper stating that you own some securities or that you've been paid for selling some securities. These days, you don't even get the paper. It's all electronic. That's because the vast majority of securities have been dematerialized. That is, physical certificates have been replaced with electronic records. The records themselves are stored and maintained by specialized institutions called depositories. The use of electronic records maintained by depositories means that securities trading can be done quickly and safely. In the old days, when all securities were in the form of paper certificates, a trade couldn't be completed until the previous owner of the securities delivered the physical certificates to the buyer. Delivery could take days or even weeks. And the couriers who carried the securities from sellers to buyers were ideal targets for thieves, so the process wasn't all that secure. When you buy a security these days, the depository transfers ownership electronically as soon as the cash payment for the security has been cleared. Depending on the time of day that you buy the security, this process could be concluded on the same day, but it will almost certainly be complete by the end of the next business day. Economists call this T+1 clearing and settlement. That is, the money and the securities are formally exchanged within one business day after the buyer and seller agree to the terms of the trade. This description of dematerialized securities and depositories probably makes you wonder in turn how ordinary people can actually trade securities. Well, the short answer is they can't without some additional help. But this isn't the only reason that ordinary people need outside help when they trade securities. The bigger reason has to do with how secondary markets for securities need to be organized in order to make them work. We're so used to the way that markets for the things we normally buy are organized that we hardly think about it. For example, think about buying groceries. If you need groceries, you just go to a supermarket, right? Well, this market is organized in a particular way. It consists of a set of competing supermarkets that each carry a similar range of products. The owners of the grocery stores establish this market by building stores and stocking them with products. They're compensated for making this market by the profits they earn from selling groceries. This way of organizing the market for groceries works pretty well because both the operators of the market and the users of the market get what they want. It enables the grocery stores to earn enough money to stay in business and hopefully earn a reasonable profit too. In addition, it meets the needs of the people who want to buy groceries. They're interested in having a good selection, reasonable prices, convenient locations, and long operating hours. Most grocery stores offer these features. A successful secondary market for securities has to do for stocks and bonds what the system of supermarkets does for groceries. It has to benefit the users of the market enough to make them want to keep using it. And there has to be a way for the operators of the market to earn enough profits to make them want to stay in business. Okay, Let's go back to the question of how secondary markets need to be organized in order for them to work. What we should probably do first is ask what people want when they trade securities. Well, there are two reasons to trade any security. You either want to trade it or you have to. Wanting to trade usually has to do with profits and losses that you've made and your expectations about future profits and losses. The reason to buy any security is because its price seems low. So if you buy it at this price, you can expect to earn a good return on it. When it comes to selling, there are several possible reasons. You may want to sell a security because you've made a big profit that you want to capture, or because you made a big loss that you want to prevent from getting larger. You may also want to sell simply because the price of the security hasn't done anything, and you think you can do better by investing in a different security. There are also several reasons why you may have to sell a security. For some securities, like stocks, the only way to convert them to cash is to sell them. You may also want to sell if something happens in your life that requires you to raise a significant amount of cash in a hurry. The ability to buy and sell securities quickly, as soon as you want or need to, is key to making a securities market attractive. This is an elusive characteristic of secondary markets called liquidity. And in particular, it's a type of liquidity called market liquidity. Liquidity is generally defined as being like cash, or being easily convertible to cash. Market liquidity refers to being easily convertible to cash, and specifically, the ease with which securities and cash can be exchanged back and forth. In a liquid secondary market, it's easy for sellers to find buyers who are willing to pay the current market price for an asset, and it's easy for buyers to find sellers. In an illiquid market, on the other hand, it's difficult for buyers and sellers to find people to trade with. So an attempt to sell a security may drive down the market price significantly, or an attempt to buy a security may drive up the market price. In highly illiquid markets, buyers and sellers may not find people who are willing to trade with them at any reasonable price. This means that the number one job of people who organize secondary markets and securities is to ensure sufficient liquidity in the market. In fact, one of the general names that economists give to people who organize or make markets and securities is a liquidity provider. Of course, traders provide liquidity too, simply by being present in a market and being willing to buy or sell. So liquidity provider is a name that includes traders as well as the specialized market organizers that we'll talk about next. One way to ensure or provide liquidity in a market is through networking. For example, imagine that I know a few hundred stock traders, and each one has told me what he or she is looking to buy or sell. Then if you come to me and say you're interested in buying some shares in McDonald's, I can probably find one of my contacts who's willing to sell them to you and introduce you to each other. But I won't do this as just a favor. If you end up trading shares, I'll ask for a small fee, a commission. What I've just described is what a liquidity provider called a broker does. A broker makes a market by matching potential buyers and sellers based on the network that the broker sets up and maintains. The broker earns a living by collecting a fee for this service, but generally only if a sale occurs. So the broker facilitates trading but doesn't do any actual trading. Some asset markets are mainly organized by brokers, so they're called broker markets. Real estate markets, for example, are broker markets. Realtors are brokers who help buyers and sellers of homes and other real property find each other. Likewise, there are many stockbrokers in the stock market who help their customers find buyers or sellers of shares. In addition to matching potential buyers and sellers, brokers often facilitate the actual trade as well. For example, brokers maintain accounts with the depositories we just learned about. So they deal with the depositories, make sure the securities are transferred correctly. Although brokers are present in the secondary markets for most securities, they aren't generally the most important organizers of securities markets. That's because it simply may not be possible to find a willing seller for every buyer, and vice versa. But this presents a problem for secondary markets. How can you create a liquid market if you can't guarantee that there will be enough buyers and sellers? The answer is that you have to provide the liquidity yourself by working as a dealer. A dealer is a liquidity provider who is always willing and ready to buy from people who want to sell securities, as well as sell securities to people who want to buy them. A dealer is a special kind of trader, and in fact, they're often called market makers. By the way, lots of secondary markets and other types of goods are dealer markets too. For example, think about a used car dealer or an antiques dealer. Both of these people are also traders who buy from some people and sell to others. In a securities market that is organized around dealers, each dealer announces two prices for each security they make a market in. One price is the bid price, which is the price the dealer is willing to pay you for the security. And the other price is the ask price, which is the price the dealer will charge to sell the security to you. If you sell to the dealer, you get the bid price, and if you buy from the dealer gets the ask price. Guess which one's higher? Well, the ask price is higher than the bid price. We often call this difference between the ask price and the bid price the bid-ask spread. This represents the dealer's revenue that they receive each time they buy a security and sell it. It's the same as a markup that a grocery store charges on the food it sells to you. Part of the markup covers the store's costs, and if anything's left over, it's profit. Another way to interpret the bid-ask spread is that it's the value of the liquidity that the dealer is providing. So how do dealers set their bid and ask prices? As I mentioned, a dealer is a special kind of trader. Dealers aren't looking to buy a security at a low price and then sell it later at a much higher price the way that most traders are. A dealer simply wants to buy and sell as many times as possible during a day so that they earn that bid-ask spread over and over. Now, in order to reach that objective, so that the dealer can stay in business and maybe earn some profit, they need to do two things that affect how they set their bid and ask prices. First, each dealer needs to roughly balance their buying and selling activity. Second, the dealer needs to make the bid and ask prices as attractive as they can to the buyers and sellers of securities, so that they'll trade as frequently as possible. Dealers follow these guidelines by changing their bid and ask prices in response to changes in market conditions. For example, if the dealer suddenly finds that she's buying many more units of the security at the bid price than she's selling at the ask price, this is a signal that she needs to adjust both her bid and her ask prices. She'll probably lower both prices. She'll want to lower the bid price because she's already bought many more units of the security than she's sold, and she wants to attract fewer sellers. But she'll probably also lower the ask price to attract more buyers to come and buy some of her excess inventory of securities. As this example shows, dealers make securities markets work not only by providing liquidity, but also by participating directly in price discovery. In a dealer market, the bid and ask prices are the market prices. Now, I realize it's a little strange that there are two market prices, but remember that there's one market price for buyers and another one for sellers because of the way that dealers earn their income. A dealer who's doing their job correctly will naturally adjust their bid and ask prices in response to changes in supply and demand, which in turn should reflect the trader's beliefs in the market about the value of securities. So in a dealer market that works well, dealers don't really set the market prices. Instead, the bid and ask prices that dealers announce simply follow the signals that the rest of the market is giving about the value of the security. That's a nice theory, you might say, but what prevents a dealer from setting any prices they want? Well, it's the same thing that works in every other market: competition. In the securities markets, there have to be many active dealers competing with each other in order to make sure that dealers follow market signals rather than set their own prices. In most securities markets, there are plenty of dealers. For example, in the 1970s, stock dealers across the United States formed a new stock market by creating an electronic communication system that displayed all the quotes from all the dealers in a particular stock in one place. The name of the electronic system is the National Association of Securities Dealers Automated Quotation System, or NASDAQ for short. So far, we've discussed two very different models for organizing a secondary market in securities: broker markets and dealer markets. But I don't want to give you the impression that these models are mutually exclusive. In any given securities market, there are both brokers and dealers, and moreover, it's perfectly acceptable for the same person to play both roles. A liquidity provider can be a broker-dealer with a hyphen. In some transactions, a broker-dealer will simply match buyers and sellers and collect a commission acting as a broker. In other transactions, the broker-dealer will trade directly with a buyer or seller acting as a dealer. Most securities dealers specialize in a relatively small set of stocks and other securities, which helps explain why they may want to play the role of broker as well. By serving as a broker-dealer, they can serve a much larger group of customers and earn a higher income. Playing the role of broker-dealer is actually quite common in securities markets. In fact, if you have an account with a broker, chances are that this company actually acts as a broker-dealer. The term broker-dealer, again, brings up an important connection to a previous lecture. Remember we discussed investment banks in the lecture on how securities are issued in the primary markets. In the US, the proper name for an investment bank is a broker-dealer. And this, by the way, is the only name the SEC will use when discussing these institutions. Investment banks act as dealers when they perform a firm commitment underwriting, because they buy the new securities from the issuer and then sell the securities to their customers. In a best efforts underwriting, on the other hand, the investment bank acts as a broker by finding buyers for a new security issue and collecting a commission for each unit of a security that's sold. There's one more important way to organize a secondary market for securities. It's different from broker markets and dealer markets, but it relies on brokers and dealers in order to work. This final way is to create an exchange. A securities exchange is simply a formal marketplace that's built for trading. In the old days, these were physical marketplaces. The New York Stock Exchange, for example, started its life as a spot beneath a buttonwood tree on Wall Street where stock traders would congregate to do business. Eventually, it moved into a grand building with a huge trading floor, a big hall with ample room for hundreds of traders who would strike deals face to face. As I've mentioned before, it costs money to organize a market, and that's the case for exchanges since they require big investments in facilities and ongoing maintenance. The way that exchanges paid for themselves is that they were organized like clubs, with members who paid initiation fees and dues. Becoming a member of the exchange was called buying a seat on the exchange, and it made you a part owner of the exchange. And just as in a private club, only the members get to enjoy the facilities. That is, only the members of the exchange are allowed to trade on it. The attraction of becoming a member of a securities exchange was not so much trading your own securities, but earning money by trading for non-members who would pay you a commission for doing so. For example, if I want to buy some stock in Procter & Gamble, I need to hire someone who's a member of the exchange to buy the shares for me. That member will locate another member who is offering to sell shares of P&G, probably on some other non-member's behalf, and trade with that member. The members of the exchange match buyers and sellers and act as brokers. Exchanges can accommodate dealers as well, and in fact, many exchanges at one time relied on dealers to organize the markets for the individual securities traded on the exchange. For example, one of the longest-lasting uses of dealers in an exchange has been the use of so-called specialists on the New York Stock Exchange. Each stock listed on the exchange has its own specialist. Specialists are broker-dealers who specialize in the trading of one heavily traded stock or a handful of less heavily traded stocks, and they're responsible for ensuring orderly trading in each of the stocks they specialize in. The members of the exchange route their orders through the specialist, and the specialist adjusts the price of the stock as the balance of orders shifts. Most of the time, the specialist is supposed to act as a broker who matches buyers and sellers, but they're also permitted, well, actually required, to step in and act as a dealer whenever trading in their stock becomes unbalanced. Their goal is to ensure liquidity in the market and also to ensure that price movements are smooth rather than jumpy. Over the years, technology has completely remade most of the securities exchanges around the world. For one thing, with the advent of the internet, there's no longer a need to trade face-to-face. Exchange after exchange around the world have downsized their trading floors or abandoned them entirely. These days, traders watch computer screens and hit the buy or sell key rather than wave their arms and shout at the specialist. That doesn't mean that trading has become any less intense, by the way. Technology has also affected the ways that exchanges engage in price discovery. In most markets, sophisticated computer software has taken the place of specialists or other human market makers. Computer programs track orders and match buyers and sellers automatically. And in many markets, they not only show traders the latest price, but they also show traders a list of how many shares people would like to buy and sell at each price. This list is created from all the orders submitted to the exchange, and it's constantly updated as new orders come in and old orders get filled. This is very valuable information that in the old days, only the specialist would have had access to. Finally, technology has made it much cheaper to start up and maintain new places to trade. All you really need these days to create a new exchange is computers and software, and both of these have become much cheaper during the past several decades. These alternative trading systems, well, technically they're competing exchanges. They were started because their organizers believed that they could organize securities markets that were better, faster, and cheaper than the existing markets. Now, I don't know whether they're correct, but one thing I can tell you is that the competition has done for securities trading what it seems to have done for other products. Trading stocks, bonds, and other securities as well has become dramatically cheaper and more convenient since the advent of the internet. One group of traders that has really taken advantage of the advances in information technology is called high-frequency traders, or HFTs for short. As the name suggests, these traders, who are companies, not individual traders, will buy securities and hold them for only a tiny fraction of a second before selling them, only to repeat the process over and over during the day. They end up buying and selling huge amounts of securities every day, hoping to profit from tiny movements in the prices of the securities they trade. Needless to say, this kind of trading can only be done with computers, and they can only do this kind of trading on organized exchanges. So stock exchanges are one of the main places where you'll find high-frequency traders. Their presence has had a big impact on the financial markets. For example, in 2012, high-frequency traders accounted for just over half of all the buying and selling of stocks in the US market. Now, recently that number has come down a bit, so it's hard to say exactly how big a role these high-frequency traders will play in the long run. But I'm certain that they're here to stay. One thing that hasn't been changed by all this technology is that ordinary traders, investors like you and me, still need outside help in order to trade securities. If you want to trade any kind of security, you'll have to open up an account with a broker or broker-dealer. It's quite easy to do. You can open an account from home with any one of many dependable online brokers out there. Just about any broker you choose will be a member of at least one exchange and will have contacts on all the other exchanges and alternative trading systems. So they will find the buyer or seller you need so that you can make your trade. In addition, the broker will handle all the details of making sure the money and the securities change hands properly and that the electronic documentation is in place. If you want more details about working with a broker and how to trade securities, I devote an entire lecture to that subject in my course, Understanding Investments. Now we've covered the basics of securities trading. We know what liquidity is, why it's important, and how securities trading provides liquidity to the secondary market.